Well, now let's turn our attention to trading instructions. Execution instructions tell us how to trade. It might be a market order. A market order says buy or sell, could be either one, but at the best available price in the market currently. So that should, if the markets are open, that'll execute immediately. A limit order specifies a price or better. A limit order to buy says buy it if you can get it for me at this price or cheaper. A limit order to sell says sell it if you can get this price or higher. Validity instructions tell when to trade. It might be a good till canceled order. So if we put in a limit order, not a market order, the market order will execute immediately, but if we put in a limit order and say good till canceled, it just stays there on the books. I'll buy shares at $30 or less. So if the stock is trading for more than that, it's not going to execute right away. Now, you might not want that order to just sit there forever until it's executed or you cancel it. So you could put it in as an immediate or cancel order, sometimes called a fill or kill order. So either execute it at that limit price or better, or forget about it. A day order just stays in for a day. It's canceled at the end of the day. Stop orders, on the other hand, have a trigger price. And it says execute if the price reaches a specified level. Well, that could be a higher level in the case of a stop buy order or a lower level in the case of a stop sell order. In terms of order execution, dealers, they are offering to buy it at the bid price, and they offer to sell it at the ask price. So the ask price is higher than the bid. They call that the bid-ask spread, and that's how the dealer makes his profit. Now, this may be very small because the dealer tries not to take too much risk. Just wants to buy at one price and sell at the other price. Now, there may be many dealers out there. In some markets we call these market makers, that all the time the exchange is open or the market is open, they stand ready to buy shares at some posted price and sell shares at some posted price. So all these bid and ask prices from multiple dealers come in. And what we refer to as the best bid is the highest bid price amongst all the dealers. Which dealer is willing to pay the highest price for 100 shares or 1,000 shares, whatever it is? The best offer or best ask price is going to be the lowest ask price. That is, which dealer is willing to sell shares at the lowest price. And so this best bid and best offer, we call that the inside market, or we just say the best bid and offer make the market. That's the market for the shares. So 1702 bid, 1705 ask, that's the market. So when you make a trade accepting the current bid or the current offer, this is referred to as taking the market. Now, a market order, as I mentioned, is for immediate execution at the best available price. That's your order to your broker. And it's useful when based on trading on information, right? If you have information you think you got it first, or you think that you've analyzed it and its impact on the value of the securities more rapidly than other traders, then you certainly want to execute now before other traders have a chance to respond to this. But a market order can execute at an unfavorable price because there's no limit on it. It just says, okay, put in my order. Well, if there's a lot of orders that get in there a few milliseconds ahead of you, this could drive the price up, or in the case of sell orders, drive the price down. So that's what we mean by can execute at an unfavorable price. Now, a limit order, remember, we buy at the limit price or lower. That's what or better means in that case. And sell at the limit price or higher. So it avoids, let's add a word here, avoids some execution price uncertainty. an order might not be filled, so it just might not be available. So if you say, well, I want to buy with a limit of 30, okay, well, you won't pay over 30, but let's say the stock's at 28, and you say, well, if it really runs up, I don't want to pay that much. So, and when you see the offer out there, the offer may be for 300 shares and you're buying 3,000 shares. So that's why your buy order might drive the price up. So to protect yourself somewhat from this, you could say, well, okay, let's put a limit. Okay, we'll enter a buy order with a limit of 29. So it might go up a little bit, but I don't want to pay over 29. And so that's why I said it avoids some execution price uncertainty. If we put the limit above the current price here, it might go up, but we know we're not going to pay more than 29. And then on a limit on a sell order, we have a similar situation on the downside. Now a stop loss order, remember I referred to that stop price as a trigger that triggers this trade, because remember this is telling us when to trade. This is not a limit order. So take, for example, a trader who owns a stock. It's trading at 35. They might enter a stop sell order at 31.50. And this is why it's referred to sometimes as a stop loss order. So I said, well, I'm going to buy a stock at 35. I might be wrong about it, right? Sometimes you're right, sometimes you're wrong. If I'm wrong, I want to get out. So I'm going to define wrong as this stock going down 10% from 35 to 31.50. So if I enter a stop sell order at 31.50, as soon as that stock, if it does, trades down to 31.50, that's the trigger, and now that stop order turns into a market order for immediate execution. On the other hand, if you sold a stock short at 35, remember you have losses if the price goes up. So in order to protect yourself, you might put in a stop order, a stop loss order, to buy at 39. So now you sell it short at 35. If it moves against you, if the price goes up to 39, clearly you have losses of $4 a share. And so that trigger price, that stop price of 39 on a buy order would trigger a market order to buy the shares and close out your short position. Now, other than stop loss, uses for these stop orders, think of a market technician, a technical trader, who believes that a trade above 60 indicates a strong upward move will follow. They might enter a buy order at 60. So even though the shares are 58 now, and it seems a little counterintuitive, but they're saying buy this stock if it goes up. Okay. Well, the belief is if it starts to go up and it trades at 60, it's going to go higher. Well, then that would be the order you want to enter, is a stop buy at 60. Let's look at an example of these execution and validity instructions. Think of an investor who owns Acme shares, which are priced at $40 a share. He wants to sell his shares only if the price decreases by 10% or more. What type of order should the investor place? Well, be careful because it's not a limit order. Okay. We want to enter a stop sell order at 36. It'll execute only if the price decreases to 36. Compare this to a limit sell order at 36. If the price is currently 40, remember that limit sell order says sell it if you can get me $36 or better. Well, if the stock's priced at 40 in the market and you enter a limit sell at 36, that'll execute immediately. And what we want here, we want to sell it if it falls. And so that's why the stop sell order with a stop price of 36. A trailing 10% stop is a stop that moves with the stock price. So if the price increases to 42, we could say, okay, well, if it falls 10% from there, I want to sell it. So that would increase your stop price to $37.80, loss of $4.20, a 10% fall. So this trailing stop, this stop is going up as the stock price goes up and just staying 10% behind it. We talked about primary versus secondary capital markets, so let's add a little more detail to that, but not much. The primary capital markets, sales of new issues of stocks and bonds. So this could be an initial public offering, the first time shares have been sold to the public, or a seasoned offering. A seasoned or secondary offering is an offering of new shares by a company that's shares are already publicly traded. Secondary capital markets, as we said, that's where securities trade after they've been first sold to the public. New York Stock Exchange, the NASDAQ, other OTC markets are all secondary capital markets. They provide liquidity and information about value to investors. Imagine if you own some shares of General Motors and you had to value those without any of this secondary market price information. Well, you can see that information is very valuable. And also the fact that the liquidity is there, so you can change your mind, go back to cash from shares, or take advantage of what looks like an investing opportunity and buy the shares without greatly affecting this trading price. That's evidence of good liquidity in the secondary markets. Within these primary markets, there's different ways that we might issue securities to the public. Now, the most prevalent is this underwritten offer, where an investment bank guarantees the security sale. At least on the day at which the securities are priced, the broker, dealer, or a syndicate of investment brokers gets together and says, okay, we'll buy this whole new issue at this price. So that's the idea of underwritten. Now, they sell them to the public at this other agreed upon price. Clearly there's some fees in there and markup over what they pay, which is going to be their compensation for handling the underwriting. But they can't just sell it. They don't just buy it and then sell it at whatever they can, right? There's an agreed upon price at which these shares are going to be offered and sold to the participants in the offering. On the other hand, a best efforts offering just says, well, the investment banker says, okay, I'll sell as many as I can. I'll do my best. And often there's a situation where it's written in there on a best efforts offer, and it says, well, yes, it's a best efforts offering, but if y'all can only sell this much, we're going to cancel it. It's not worth going public if we don't sell at least this much. A private placement refers to securities that are sold to qualified investors. These are shares that haven't been registered for offering to the public. So qualified investors, typically called the rich or smart rule. The idea being if you're rich, you can hire smart people. But qualified investors, investors who should know enough to protect themselves and don't need this registration process to help them out and protect them. So maybe an insurance company talks to a company and says, yeah, we need some 15-year debt securities. Would you like to issue some 15-year bonds? Yes, we would. Okay, let's do that transaction. A shelf registration refers to registration of securities that are issued over time. So rather than all being offered at once in an initial public offering, a shelf registration, they'll register shares and then they'll sell them as they will. They've been registered, but they just haven't been sold yet. Dividend reinvestment plans refers to firms that issue new shares or shares they purchase in the marketplace to shareholders who reinvest dividends. So that way, instead of having a cash accumulation there from dividends, each of those dividends is invested in additional shares, and it doesn't have to be whole shares at that point. It could be fractional shares. They just keep track of it within their DRIP, or dividend reinvestment plan. And a rights offering gives current holders the right to buy new shares at a particular price. So it's a way, if you say you're a holder and you own 1% of a company, and they're going to issue some new shares in a secondary offering. Well, those new shares are going to go out and you're not going to own 1% anymore. So what a rights offering does is they give existing shareholders the right to buy these shares at a specified price. So since the company's raising new money, if you want to still own your 1% of the company, maintain your proportional ownership, then you would buy your proportional share of the new shares under what's called a rights offering. So just remember, it's the right of current shareholders to participate in this offering of secondary offering of new shares at a specific price that's often advantageous to them. Market structures. Well, we've got quote-driven markets where investors trade with dealers. So you think back to our dealers that are giving us the market, the bid and the ask. Okay, so that's the quote that's driving that market. In an order-driven market, rules are used to match buyers and sellers. So an order comes in, a market order. Well, the rule there is that the first one in gets executed first. So they've got buy and sell orders and they're matched up. And this is, of course, done by computer these days. It used to be a much more manual and talkative effort. And brokered markets are where brokers find a counterparty for a trade. So they go in and say, okay, I've got these shares to sell. Find somebody that will buy them. And we don't have specific examples here. When we talk about over-the-counter markets, we're most often talking about dealer markets or quote-driven markets. But many of our markets these days integrate aspects of both. Call versus continuous markets. We touched on this earlier. Securities trade at specific times so that all these bids and asks are accumulated. Then this price is set that clears the market, or as I referred to it before, kind of balances, finds a balance between supply and demand. And it's used in less developed, smaller markets and, as I mentioned, to open major markets such as the New York Stock Exchange, where we've accumulated buy and sell orders since the previous day's close. Continuous markets, trades occur anytime the market is open. Price is set by auction or by dealer bid-ask quotes. So when we talk about auction, then we're talking about an order-driven market. What are the qualities of a well-functioning financial system? Well, one, that it's complete. Assets and contracts are available. It's operationally efficient. When we talk about operational efficiency, we're talking about low transaction costs, right? The efficient execution of trades, buys and sells. When we talk about an informationally efficient market, that's where the prices reflect the intrinsic value given all the currently available information. And we'll develop this concept of market efficiency much more in a later reading. And these financial intermediaries facilitate transactions. Well, what are the objectives of market regulation? Well, our first one here, protect unsophisticated investors. So many of you are kind of smiling at that. It's impossible to really protect unsophisticated investors. Time and time again, we've proven that. Okay? But let's say offer some protection to unsophisticated investors and require minimum competency standards for participants in these markets, the professionals in these markets, prevent trading on inside information. Remember, inside information is material, that is, buyers and sellers would want to know it. Okay? And it's non-public. Okay? So if you have information that this company is going to make a buyout offer on this other company that's $10 above the current market price, that would be, in most cases, material non-public information. And market regulation requires common financial reporting standards. And that's very important. And of course, we mentioned that securities are registered for public trading by the SEC in the US and other organizations in countries around the world. And while these don't protect investors from making mistakes, they do require some minimum level of disclosure, and they require the participants in this, the principals, to sign off on these disclosures. So we're trying to get clear information that investors would find valuable in determining whether or not to purchase those shares, and to hold the issuers of that information accountable for it. And our last point here, require minimum levels of capital. So we don't want brokerage houses and other financial institutions to get in such a leveraged position that they're going to fail and do a lot of harm to market participants as a result of that.